welcome. You're listening to Michelle Price, business editor of The Banker magazine, and I'm joined here today by Charlie Corbett, economics editor of The Banker magazine, and today we are discussing the hot topics of this year's Sibos in Hong Kong. Charlie, tell me, how do you think the atmosphere will differ from last year's Sibos, bearing in mind Lehman Brothers did collapse on the first day of the event?
I think one of the main differences of this year's Sibos compared to last year will be that last year's was conducted amid scenes of panic, really, and I think this year we're going to see the dust settling a bit. The panic has subsided a wee bit, and as the dust settles, we'll begin to see, hopefully at Sibos, how this new landscape, is emerging post the crisis. Some of the bigger questions perhaps about financing trade, how banks are going to be greasing the wheels of trade in future, because obviously trade finance has been hit very hard. Banks aren't financing people. Companies can't get credit. How are banks helping their clients maximize their cash? These are all very important questions, and particularly now, these guys in the transaction services division have never been under the spotlight in quite the same way. So all those factors will be very interesting this year, Michelle. Okay, risk and regulation are going to be key issues looking ahead. What is the most important issue, do you think, looking ahead into the second half of 2009 and 2010?
Thanks very much, Charlie. Well, I think obviously there are some big philosophical questions to be answered at a much broader level, and a lot of people are sort of scratching their heads as to, sort of what are the limits of regulation, how much risk can the system take, and who is responsible, and how on earth are things actually going to be engineered in such a way as the politics doesn't completely subsume the ultimate goal, which is to create a functioning regime with minimal systemic risk, or at least systemic risk that people can visualize, monitor, and hopefully mitigate. I think the really biggie at the moment, Charlie, so to speak, is going to be liquidity risk. The FSA in the UK has been leading the way in so much as it has issued some quite stringent and prescriptive guidelines on how it wants organisations to manage their liquidity and their liquidity risk going forward. And this is only just starting to gain any real momentum in the marketplace. A lot of banks have been scratching their heads and sitting on their hands, not doing very much, according to my sources. There are some banks who have been quite active, but this is a very unclear and unknown area right now. Now we have a sense of what the FSA requires, but we don't really have any sense of just how much effort it's going to take and how much money it's going to take for the banks to be able to provide this. And more broadly speaking, we don't really know what it's going to mean ultimately for banks' business models. We don't know what it means for London, for example, as a location. Is it going to be as attractive as it has been historically if the FSA imposes stringent liquidity requirements on subsidiaries and branches located in London? And we also don't know, for example, what the other regulators globally are going to do. Now, plenty of people in the marketplace feel and have told me that other regulators will be taking a similar lead to the FSA, whose own guidelines are drawn, of course, from the BIS and the Basel Committee, who issued initial guidelines before the collapse of Lehman Brothers. However, we're not entirely sure if the flavour will be similar, what the sort of the precise details of that will be. And I think there are some questions to be answered about the detail there. Regulation is all about the detail, and whether or not, we will actually be creating opportunities for regulatory arbitrage, which was a key stated goal of the G20. The obliteration of regulatory arbitrage was a key stated goal of the G20 in March, April this year. And it was a key criticism of commentators on the crisis in the last few months. So I think the regulatory arbitrage issue is one that needs to be considered. There's also obviously the IT costs involved. Do the banks have enough money? Are they willing to spend it? And how long is it going to take? Will they meet their deadlines? And really, what does it mean for how banks fund their operations and their business lines? And which business lines are they prepared to remain in, and which business lines will they have to exit? So I think this is a really, really big issue for the industry. I don't personally think it's received the kind of attention that is required. I mean, if you look at the expansive nature of what the requirements really demand of the banks in terms of visibility across all their businesses, you know, from your depositors and your credit card business all the way, you know, to your prop traders trading in, you know, commodity derivatives. I mean, this is a vast and expansive and hugely challenging regulatory regime that we are seeing unfolding here. And I think there are lots of issues here to be discussed.
Beyond liquidity risk, what other issues over regulatory oversight will be discussed this year at Sibos, do you think, Michelle?
Thanks, Charlie. I think the other issue, obviously, that has been sort of a raging debate for the past few months, certainly since the collapse of Lehman Brothers and the near-death experience of AIG, has obviously been the credit default swap industry and more broadly the credit derivative industry. And the real issue there has been that the policymakers have felt that the only real way to deal with the market or to mend the market is to sort of thrust it into the disinfecting cold light of day and to put everything onto central order books and you know, exchanges and push them all through clearing central clearing counterparties. But I think you know, that as a panacea has yet to be proved, and there are obviously plenty of people in the industry who feel that this is not necessarily the way to go, at least not with every single instrument out there in this regard. So I think there are also big issues there around how much does sort of central market infrastructure, how much of a role does that play when we are trying to sort of re-engineer the financial system? And have the debates regarding this particular issue been as informed as they might have been? And is ultimately the vision put out and put forth by the US Treasury and the Obama regime, is that ultimately possible? And will the regulators actually destroy the very industries that they're attempting to regulate? And is this their ultimate goal?
I want to talk a little bit about MiFID now, and you wrote an article about this time last year titled "MiFID Slips into the Dark." You said that a dream of a highly transparent single European market for trading was a long way off still, and that MiFID was not delivering on its promises. 12 months later, what has changed?
Thanks, Charlie. Well, I think quite a lot has changed in so much as some of the particularities of MiFID and its implications for the marketplace have become a little clearer. But there are obviously issues that the bureaucrats in Brussels could not necessarily have foreseen. And I think one of the major issues about MiFID is that it's dealing with a marketplace which is almost entirely driven by technology. And therefore, technology is driving business models in a way that some individuals who were architects of the legislation were perhaps not able to see in advance. And this has led, in some instances, to the proliferation of so-called dark liquidity, which some critics of the industry have claimed is actually a negative for the industry. It disrupts price formation, and it's actually reduced the transparency of the market rather than increased it. And that would be a somewhat ironic result for a directive whose major aim, or major stated aim, was to increase transparency and efficiency and also to reduce costs. And on that other issue, the market infrastructure piece has also come into play recently, or during the past 12 months, since it's now clear that it was not so much the explicit costs associated with trading, i.e. the fees associated with trading on a given exchange, that were the main issue, but rather it was the sort of the back-end plumbing on the clearing and settlement side that was really the most cost-intensive part of the entire process, and therefore that has also received a lot of attention recently. But the big question is really, where does MiFID go from here? We've had the assessment from CSER of late, which did point up some issues. There's obviously going to be some revision. We know that some of the regulators have been looking into this issue of dark liquidity, and not just in Europe and in the UK, but also elsewhere, not under the MiFID regime in the US. It is clear that the technology is driving new ways of trading in new environments that have caused some discomfort amongst the great and the good of the SEC. So I think we're actually seeing a broader trend in cash equities trading, which is not just related to MiFID necessarily, but is quite an interesting trend, and one which will be very pertinent to the next version of MiFID, certainly. So, Charlie, we've talked a lot about risk and regulation, but Sibos is, of course, a transaction banking conference, and transaction banking has probably never been more topical or more sexy, as it were. So tell me a little bit about what you think the big themes and issues are going to be in that particular area in Hong Kong this year.
Yeah, I think sexy's a bit strong. But yeah, it's certainly, it's a case of Cinderella finally going to the ball, when all their flash colleagues in the capital markets divisions were making loads of money. The transaction bankers were just seen as the kind of rather dull engineers. But now the management of banks are focusing ever more on these on this particular part of banking. It's bringing in revenues, steady revenues, probably not a lot because margins are tightening. I think some of the issues this year are obviously going to be very similar to last year, because obviously we've had 12 months of a complete distraction from dealing with such things as SEPA and PSD, the Payment Services Directive. Some would say that these have been subsumed by broader issues in the market. The financial crisis has diverted banks' attentions into sort of really, surviving rather than focusing on complying with yet more regulation being issued from Europe. Rather like the family spectre, it was all hands to the pumps last year, and SEPA and PSD were out of their minds. But it's likely that as the initial panic subsides now, and we're not panicking anymore, these are issues that are going to come back to haunt bankers. So, this whole issue, I think, of setting a date to comply with SEPA's going to come up again. It's people constantly talk about it, and the same with the Payment Services Directive, which does have a date in November. There's a deadline for November, Michelle. So technically banks will be breaking the law if they don't comply with that. But it's a bit like herding cats, and it's very hard to get people to do something that's going to cost them money and reduce their revenues. It's a bit like paying someone to take money out of your pocket. But ultimately, they are going to have to comply in the end. But there are big problems, and especially since individual countries are allowed to tinker with the obligations of the legislation. This is the PSD I'm talking about. So that's just a charter for procrastination. If you look, France has now delayed implementation of the PSD, so others will probably follow, and it's hard to see this coming together, really.
Thanks very much, Charlie. This is Michelle Price and Charlie Corbett. Thanks very much for listening.